In 2007, an American retail giant was worth $30 billion. A little over a decade later, it was bankrupt. Now, this isn't just another story about the death of retail. This is a strategic autopsy. And as we're about to see, the evidence suggests the fatal wounds weren't inflicted by some outside force, but from within.
To really understand the scale of the collapse, you first have to appreciate the peak. In 2007, Sears Holdings had a market capitalization of nearly $30 billion. This wasn't just a store, it was a true American institution.
And here's where it gets truly staggering. To put that $30 billion in context, at that exact moment, Sears was valued at nearly twice the size of a little up-and-coming online bookseller you might have heard of, Amazon. This presents the central paradox, doesn't it? How does a market leader with such a massive advantage just vanish?
And the collapse was just as epic as its peak. Between 2011 and its bankruptcy filing in 2018, the company didn't just lose money, it hemorrhaged it, over $11 billion. This wasn't some slow, gentle decline. It was a catastrophic, systemic failure. So the real question here isn't what happened, we all saw that. The question is why. Our strategic autopsy is going to move beyond the headlines to dissect the hard evidence and diagnose the precise internal causes of this corporate death. So, here's our protocol for the investigation. We'll start with the anatomy of the collapse itself. Then we'll dig into the customer disconnect, what I call the cultural rot, and a full financial autopsy, before we arrive at our final diagnosis. The examination begins now.
Section 1. The anatomy of a collapse. First, we need to establish the vital signs, both before and after the system failed.
And the data here, it just points to a complete systemic breakdown. This was not a cyclical downturn. We're talking about going from the largest retailer in the entire country with almost 4,000 stores down to the 31st largest with under 900, from being profitable to being buried under more than $11 billion of debt. The vital signs are crystal clear.
Now, it's really easy to just point the finger at Amazon and Walmart and call it a day, but that's a surface-level diagnosis. The evidence we're about to examine suggests the real pathology was internal. The fatal wounds were absolutely self-inflicted.
Okay, Section 2, the customer disconnect. This is the first major internal issue we're going to uncover. A company's relationship with its customers, that's its lifeblood. And for Sears, that relationship had become toxic.
This analysis of customer sentiment is incredibly revealing. You see, the most common and most negative complaint wasn't about price or even product quality. It was about making a phone call, just the fundamental act of communication. This tells you it wasn't about a few isolated bad days. It was a system that seemed designed to create friction for its own customers.
And this data here, it quantifies just how fast that decay was. The percentage of positive customer reviews, after a little bump, just completely collapses to a little over 5% by 2015. I mean, that's a clear metric showing a total failure of the company's core promise. Data points are one thing, but a quote like this from a customer in 2014, it puts a human face on it. And that word, lying, that signals a complete erosion of the most critical asset any brand has, trust.
Which brings us to Section 3, the cultural rot. See, failures in customer service like this, they aren't an acute illness. They're symptoms of a chronic, pre-existing condition buried deep within the company's DNA.
And we found one of those conditions dating all the way back to 1991. It was called the Productivity Incentive Plan. In simple terms, it was a pay system where auto center employees had to meet sales quotas for parts and services just to keep their jobs. That right there fundamentally changed the relationship between the employee and the customer.
And the result was, sadly, predictable. An investigation found widespread fraud. Service advisors felt pressured to sell customers repairs they didn't actually need, with overcharges averaging $233 per car in one case. The system itself was incentivizing behavior that hurt customers and destroyed the company's integrity.
So this raises a critical question for our autopsy. That scandal happened in the early 90s. It makes you ask, were the disasters of the 2010s something new, or was the company's very DNA, its core operating system, already programmed decades earlier to value internal metrics far more than customer trust?
Okay, that brings us to Section 4, a financial autopsy. Because this pre-existing cultural condition, this obsession with internal numbers over customer value, it set the stage perfectly for the final act. Now we turn to the Lampert era, where this deep vulnerability wasn't fixed, it was financially exploited.
And any analysis of this time has to tackle the central debate.
Was this a genuine, if failed, attempt to rescue an icon, or was it a strategic, deliberate extraction of value from a dying company? Well, the evidence will give us our diagnosis.
Take a look at this timeline. It shows a systematic dismantling. One by one, the company's crown jewels were sold off. First Allstate way back, then Sears Canada, then the very valuable Land's End brand, and finally, its most valuable asset of all, its real estate, which was spun off into a whole new company.
And this chart really reveals a critical decision. Between 2005 and 2008, the company spent over $5 billion buying back its own stock. That was money that was not spent on capital expenditures, improving stores or technology. It was a very clear choice to focus on financial engineering instead of investing in the actual business. And while Sears itself was collapsing, this financial strategy generated huge returns for Lampert and his hedge fund. We're talking billions in performance fees, hundreds of millions from selling off those assets, and even hundreds of millions more in interest from loans that his own fund made to the failing company.
Which brings us to Section 5, the final diagnosis. After looking at all the evidence, we can now synthesize everything into a clear conclusion.
The final diagnosis is really a tale of two opposing strategies. In the 90s, under CEO Arthur Martinez, the strategy was value creation, investing in the business, focusing on the customer, and it led to a huge turnaround. Then, in the 2000s, the strategy became value extraction, monetizing assets, cutting investment to the bone, and it led directly to bankruptcy. The evidence shows two totally different philosophies, with two totally different results.
So, this autopsy of Sears leaves us with one powerful, universal lesson. The final question that every leader has to ask is this: is my organization fundamentally built to create new value for our customers, or have we just become a very efficient machine for extracting the value that was created yesterday? Because as Sears proves, the answer to that question determines survival.